all across the crypto industry and mainstream finance, especially around the DeFi sector. The term Rugpull has been used repeatedly to describe a very disastrous situation that occurs in decentralized finance and elsewhere in cryptocurrencies that can leave an investor with extreme losses. The prevalence of the issue has become so widespread, even Dallas Mavericks owner and billionaire Shark Tank investor Mark Cuban was reportedly rugged as part of a DeFi protocol issue. The prominence of rug pulls in the industry suddenly put a damper on prices and set back the market by months. It also has investors worried about where to put their capital. Hello everyone and welcome back to the Metaverse Economy channel. In this video, I'll explain what a rug pull is, how it happens, and how you can avoid them and protect yourself in the market. Don't forget to subscribe if you want to catch more videos like this. If you're standing on a rug and it's suddenly pulled out from under you, unless it's a magic carpet, you fall on the floor. Worse yet, you might spill or lose everything you were holding onto at that moment. That's exactly why you need to be aware of rug pulls, especially when you're trading a volatile crypto asset. A crypto rug pull happens when developers create a token paired with a valuable cryptocurrency, list the token on decentralized exchanges, and then pull all the funds out after the investors buy in. Rug pulls are usually perpetrated by malicious scammers who create hype around a coin and then abandon the project, running away with the money. These cryptocurrencies are usually paired with reliable utility blockchains, be it on Ethereum or Binance chain. This is because investors who swap their Ether for the listed token give the creators of the token a chance to withdraw the Ether from Liquidity quickly. For example, meme coins are one of the creators that cause investors to concede into the FOMO spirit and get rug pulled. Rug pulls usually happen within the decentralized finance or DeFi space by pulling funds from a liquidity pool. To understand this in depth, we need to know how liquidity pools function. A liquidity pool is effectively a market maker for decentralized exchanges, meaning it provides buy and sell orders for a given token. Because there is no centralized system for facilitating trades, crypto exchanges need a way to keep order flow going. It's also easy to list tokens on a decentralized exchange because there's no one to audit the token. At its core, a liquidity pool is a pile of investor funds locked in crypto pairs that allow users to trade between different cryptocurrencies. Crypto pairs usually include a popular cryptocurrency like Ethereum's Ether because it's a well-established platform token with high availability to encourage investors to pool their resources and act as a liquidity provider, LP. A trading fee is charged on orders and awarded based on the total value lent to the pool, similar to a dividend. In exchange for the crypto in their wallet dedicated to the pool, each user is entitled to a percentage of the overall fee. The higher the amount lent, the more money an investor stands to make. Creators of liquidity pools vie for more investors by offering higher yields. Examples of rug pulls are numerous. In fact, in 2021, over 1,300 exit scams were pulled. These range from small value scams in the thousands to entire market users being taken for billions of dollars worth of Ether and other coins. In one of the most publicized cases of 2021, Thodex, a Turkish-based platform, was closed and its founder, Fark Fatih Özer, is rumored to have fled to Albania with approximately $2 billion of investor funds. Özer is still on the run, but is being pursued internationally by Interpol and other agencies. Thodex built an active user base of 390,000 financial users. In April, the decentralized exchange was unexpectedly closed. It's still unknown where the missing funds went. Another case in June 2021 was Whale Farm, a DeFi project token offering users unprecedented returns in exchange for staking its pool, crashed 99% in a matter of minutes, chart below, scamming investors out of $2.3 million worth of cryptocurrencies. The team, which was entirely anonymous from the start, is still unidentified. Even bigger was the Luna Yield rug pull. In August 2021, a criminal group walked away with nearly $7 million of funds taken from investors in one of the largest cryptocurrency DeFi scams to date. All social media accounts and the website for Luna Yield, a project on the DeFi platform Solana, were closed down. When users withdrew or unstake their funds, they found the pools were empty. They had fallen victim to a rug pull. 2021 also saw DeFi platform Compounder Finance set up a rug pull worth over $10.8 million in stolen customer funds. A breakdown revealed that contracts worth $5 million in DAI, $4.8 million in Ether, and $750,000 in wrapped Bitcoin, WBTC, were drained from Compounder Finance. In a scheme that sounds like something out of a thriller, the team replaced their secure and audited contracts with malicious ones that enabled them to steal locked investor money. They also cleverly mimicked the name of Compound Finance, a legit DeFi interest-earning protocol, to lure their marks into investing. In March 2021, Meerkat Finance, a DeFi yield project using forked cryptocurrency of Yearn Finance, perpetrated a rug pull worth $31 million in crypto assets. The platform's official Telegram channel claimed that its smart contract vault had been compromised. Investigations suggested that either the private key of the Meerkat deployer was compromised or the incident was self-directed by the owners of the project. These and many more are examples of rug pulls that make it very important for investors to protect themselves when looking to invest in crypto. Although exit scams and rug pulls have tripled in 2022, the total monetary amount stolen is dropping because investors are learning to watch for the signs. If you know what you're looking for, it becomes easier to avoid these schemes. I'll discuss some common signs to help you avoid falling victim to such an exit scheme. Firstly, extremely high yields. Many DeFi pools offer to facilitate the trade of tokens and lend them inside, creating extra yield to investors in the pool. Whale Farm, for instance, offered rates that exceeded 100% APY. If you see a yield farm offering returns that are too good to be true, they probably are. Another thing is that the creators remain anonymous. There may be a rationale for creators to remain anonymous, from security and privacy to personal reasons. However, anonymity also makes it harder for bad actors to be tracked after pulling off a scam. If a project is started anonymously, with new social media accounts created within days or hours of a launch, that's a big red flag. If projects have no ties to other successful projects or the crypto community as a whole, that's also a red flag. Look on a project's website for meaningful information about the team. If it's just a bunch of fluff, proceed, if at all, with caution. Also watch out if the coin prices skyrocket. With any asset, if you can't see why the value is rapidly increasing, beware. Scammers can inflate a project by either putting in funds or creating false hype to get people involved in it by exploiting the FOMO, fear of missing out. Look for legitimate reasons such as new exchange listings, partnership announcements, or other good news that could be driving the spike. If these are non-existent, it may be a rug pull or pump and dump scheme. Remain skeptical unless you have a good reason not to be. If you notice any extensive marketing tactics, then you might want to take a step back. Most crypto scams are designed with a rug pull in mind. Because of this, the use case for the token or pool is vague and unpractical. Instead, the creators rely on social media posts, crypto influencers, and paid advertisements to gain support. Try to understand the legitimate use case for a project before jumping into a new token or pool. All sizzle and no steak won't provide anyone with a good meal. No liquidity lockup is another red flag to look out for. Most legitimate liquidity pools lock in investor money for a certain amount of time. This does two things. First, the pool liquidity needed for token swapping, lending, and other activities is ensured so that the pool can continue to function. Second, it keeps the creators from quickly emptying the pool once it gets to a certain size and running away with the money. A locked pool helps to safeguard investor interests. If there's no lockup, it's another red flag. By exercising caution and looking for the signs above, investors can mitigate the risk of becoming trapped by a rug pull. Prudent investors exercise caution when entering new markets or investing in new pools. Greed can make poor business decisions seem much safer than otherwise, so knowing the signs of foul play will decrease one's chances of falling prey. Avoiding scams and potential rug pulls in crypto projects ultimately boils down to awareness before investing and doing your own research. Here are a few more ways to check the legitimacy of any project. You will want to take a look at the liquidity. One way to assess a token's legitimacy is to check its liquidity. Legitimate projects usually have millions in liquidity. These projects lock up a significant amount of tokens for a long time, and again, they cannot be withdrawn from the liquidity pool during that time frame. Check the project's staking period and verify the amount of liquidity belonging to a project's owners. Legitimate platforms like PancakeSwap and Uniswap usually have liquidity information readily available. Another important thing to do is to confirm the team's credibility. Any project that's potentially a rug pull is defined by its owners and creators. Their relevance to the cryptocurrency space, as well as their previous involvements, track records, social media, industry history, and connections must add up if they are to gain credibility. The more questions than answers about the owners and team, the more likely the project is to be a scam. Rug pulls are usually very well planned and blatantly executed. The tokens that have been created promise exciting developments and garner a lot of attention in a short span of time. Instead of executing token sales, however, the teams behind the hoax are orchestrating an exit scam. Investors often don't realize it until the token is drained of all value and its creators have long disappeared. With growing interest in crypto, the stakes are becoming increasingly high. Scam artists are constantly looking for ways to make a quick buck off of unsuspecting victims. By keeping track of common signs of exit scams and conducting due diligence on prospective projects, you can decrease the chances that their next victim will be you. Thanks for watching, and if you found this video useful, please hit the like button and don't forget to subscribe.